Welcome to Advisor Wars, the podcast where we take a critical look at the key issues facing the financial advisor profession. I am Bob Hoopsher, and co-hosting with me is Joe Halpern, Managing Partner and Chief Investment Officer of Obsidian CIO. I was the founder of Advisor Perspectives and led it as its CEO until 2024. During the time I was there, it became the most widely read publication among financial advisors. We are recording this in mid-January, and our topic is the 5 requirements for using alternatives appropriately. We'll identify practical rules for vetting, incorporating, and explaining alternative investments over the next 30 minutes. Advisors will learn how to safely and effectively allocate alternatives. So, Joe, before we talk about how to incorporate alternatives, let's remind our audience what falls into the category of alternative investments for the purposes of our discussion.
Thank you, Bob. It really encompasses anything that is not public equity and public credit. And I'll add one other characteristic, that it is non-liquid. So when you think about the structures, an interval fund, which we spoke about last episode, closed-end funds, tender offers, anything where you cannot get out in a day, will highlight as an alt. And then also just not that public credit, public equity. Another way to think about it is it's not ETFs, not mutual funds. Bob, I'd like to just also highlight why are we doing all this? Like, why should we be focusing on alternatives? And one reason to focus on alternatives is because the largest asset managers in the world are seeking to democratize the space. The likes of Apollo, Blackstone, etc., are going to high net worth and essentially pitching why alts are really worthwhile. We discuss it ad nauseum in episode number 1, but it's really important, we believe, that every advisor at least has a narrative of why they do or don't do alts. And if they do alts, then listen to the show to learn more.
Great. So given that they're non-liquid, are they appropriate for all clients that an advisor might have, or is there a baseline level of, say, net worth or portfolio size that's necessary?
Yeah, there's definitely a baseline, Bob. And the way I would think about it is A, time horizon. What is the time horizon for the client? And B, safety net. What kind of safety net does the client need? And so using one round number, $1 million, if you have a retiree who's in the decumulation stage and needing to pull out of their investments versus a lawyer in, an upcoming rising lawyer in a big practice, which is quite stable, versus an entrepreneur. All 3 of them have a $1 million in liquid net worth that they want to invest. Those 3 look very, very different. Person number 1, in the decumulation stage, probably not putting any alts. Person number 3, entrepreneur, they tend to have a more volatile career. They have better upside, more downside. That's another one where I'd be careful about whether you put any alts in that million. But the lawyer, by the way, you could put a reasonable amount of alternatives in that portfolio just because they're a bit more stable. And again, those are 2 characteristics you'd want to understand: family dynamics, all these other elements about the client, but high level, that's, I think, directionally appropriate.
So you have to look at what people call the human capital of an investor, their potential earning potential and the volatility of that potential. So let's talk about the first requirement, which is understanding the exposure that a client has or should have for alternatives. What should advisors look for? How do you determine the appropriate size of an allocation to alternatives?
Yeah, so the first, it's worth reminding the audience here that the goal of alternatives is to diversify and potentially to provide an opportunistic exposure on behalf of the client. And so stepping back, most clients have exposure to public equity and public credit. And we'll use private credit as an example. We'd look at a client and say, hey, let's go and provide private credit as a diversifier. When you think about the characteristics of public credit, it's predominantly fixed. So you have a fixed rate that one receives when going into the exposure. And then you have duration risk and other, call it, benefits and risks involved. Public credit is primarily variable rate. So right there, just by having variable rate versus fixed rate, it throws off very, very different characteristics where if you're in an increasing yield environment, decreasing yield environment, these products act very differently. And so that alone would diversify you. Now, thinking about a client and using an example of where you really do need to focus, obviously, on each and every client. If you have a client who, let's say, their career is in commercial real estate, and this client happens to own some private real estate, well, you most likely would not want to then provide more exposure to this client by putting them in really anything that touches real estate in the alts world. And that could, by the way, go all the way to infrastructure. It's an area we looked at very closely last year, looked at a lot of managers in the space, and there's a lot of elements of infrastructure, which is real assets, real estate. And that's an example where you'd want to stay clear for that specific client. So broadly, big picture, you want to look broad at what is the typical exposures for my clients? And then for each client individually, what's the idiosyncratic kind of characteristics of that client and how do I work there? So big picture is broad diversification, and then you could get narrower and narrower.
Great. So let's move on to this second requirement, which really focuses on the technical aspects of the alternative investment that you're considering. I'm going to break that into three parts. And the first of those has to do with conducting the appropriate level of due diligence on the investment. Where do you start when you look at a candidate for an alternative investment? How do you assess its risk, its return potential, its advantages and disadvantages relative to comparable investment?
Yeah, so once we get a little bit more into the weeds, we have a really robust due diligence framework. And we actually use AI a bit for that framework in finding, because there's a lot of docs involved and you need to look at the underlying docs. It's great to look at presentations. They're pretty. They say a lot of nice things and it's compelling. And then when you get to the docs, you learn a lot more about the actual underlying investments, about how it's being run. One area I personally make sure to look at within the prospectus or the subscription docs is the risk section. That's where you're going to find conflicts. In risk section, some of it is very general and very high level, and you could skip those few lines, but that's where you're going to find some stuff about, again, the management, the exposure, the approach. So by using that due diligence framework, we have our own process where we make sure we don't miss anything. That's what the framework's for. And then kind of moving back up a little, Bob, to another thing we really focus on, and this is throughout the mandate, throughout the initiative, is really speaking to all the managers within a defined space. So if I'm looking, let's say, in infrastructure, we're speaking to everyone, and then we're very transparent with these managers. We want them to understand what we're looking to do, what our initiative is, so that they understand how they should be communicating with us. And then we want them to understand who else we're looking at, because they know their competitors best. And they're going to be able to really define the nuances. And sometimes there's extreme differences between approaches by managers, and sometimes it's a little bit more nuanced, and you really need to understand it. So I'd say those are the two ways we look at it.
So the next aspect is the underlying exposure. These alternatives typically provide exposure to an underlying asset class, such as infrastructure that you just mentioned, or private credit or private equity. How do you evaluate the risks and opportunities in that underlying vehicle?
Yeah, so it is so important to look at the underlying exposure within these vehicles. My career started, I worked in complex derivative products, and it's surprising I've been on the street close to, I guess, 30 years at this point, not close to, at 30 years. And it's surprising to see how many broken derivative-based strategies have been out there. They're broken, so they don't exist anymore, where the exposure just did not match the marketing. And if you looked underneath and you understood the exposure, you would not get into the product. And I'll use an example. The first time our team collectively, and I personally looked at a CLO, a collateralized loan obligation, I spent I was going to say an inordinate amount of time, but it wasn't inordinate. It was an appropriate amount of time to understand every element of it. What exactly are these securities? Who's putting them in place? How does the waterfall work? They're fascinating products, but you need to understand, we really understood. Where's the fees and expenses? Where explain to me this month how every single penny comes off this waterfall. We went on site and sat down with the portfolio manager and peppered the portfolio manager and said, explain this, explain that. And then I made everybody on the team do the same thing. The same thing. Go and really, really understand it. And then, kind of coming back to, because you mentioned infrastructure, probably because I brought it up as an example earlier. But when we looked at infrastructure, you find out, I guess it's more you focus, because it's not like so hard to find out, but you focus. There were a couple of managers who were really geared environmentally. So they had an environmental bias. There were other managers who jumped on the bandwagon of AI, meaning that they're really focused on energy and data centers. And that's very different than a broad exposure to infrastructure. So neither of those two statements are problematic. You just have to know what's the exposure you're getting into, and is that what you want? Do you want environmental data centers and energy? That may be the reason why they perform really well. I know we'll get to it. But is that what you want going forward? So that's how we think about it.
Great. Well, let's talk about performance. That's one aspect of what you look for in an alternative manager. But what are the key elements that you want to see in the investment process? And how much weight should you place on the track record versus the opportunity set that the manager has?
Yeah, so you really care about the positioning of the manager, how they're shifting exposures. So you want to understand their process of what makes you sell something, what makes you buy something else. You want to understand the organization, who's managing what, who's backup for that manager. You want to understand the culture. One thing I really look closely at when speaking to, I'd say to anyone beyond even the manager, but like, how do they interact with you? What do their decks look like? When you ask for something, how do people get back to you? Are they polite? It just tells so much about culture, that interaction, and it's amazingly different amongst managers. And obviously you could get, I'd say lucky or unlucky, you could have an outlier, you could have a very good salesperson and the rest of the team's not good, but you want to look through and just try to understand, how is this organization running? And then comp. How are these folks compensated? Is it aligned? Because sometimes there's just a lack of alignment. And then you spoke about track record. Track record's really important. You want a manager that has not only expertise but experience, that's been around. It is one thing to understand academically what a downturn feels like, or looks like, I should say. It's really different to feel it and to go through it. And I've had, I guess the luxury of going through a whole bunch of downturns, whether you call it a luxury or not, I'm not sure. But I still remember in 2008, I was part of a pretty senior team, and we had someone from one of the French banks who came who's young. He's 24, 25, his first, and they lost a lot of money because they just didn't have, it's not about, you just can't visualize sometimes what's going on, and you just think in terms of, okay, that's the volatility, this is the standard deviation. Well, what happens if something beyond your imagination occurs, which typically occurs in the downturn? So that experience is so important, but I will temper it with what you sometimes see in long-term charts. So a mountain chart is a chart that incorporates many years. And this is something I would say folks really need to look out for, where I've seen so many examples where people say, hey, look, this is my annualized return over the last decade, over the last 15 years. And it's a mountain chart, so it's capturing it all, which means there's compounding. If the early years you did really well, you get a compounding effect that allows your line to stay above the bench for a very long time, longer than it should. And then the other function of that is that in the early years of the strategy, there might have been few assets, and there might have been kind of an outlier position, a position that the manager would not hold anymore that you wouldn't want them to hold. And so it's so easy to get caught up by a beautiful performance. And that's one area, the mountain chart's one you really need to be careful of. Again, it doesn't mean that people are trying to trick you. You just have to recognize the compounding element. You have to recognize, where's this performance coming from? Does the strategy still look the same? Would the manager do the same thing now that it's more mature? And all these other elements that start hitting into performance, which is really easy to look at and get really connected to.
Yeah, no manager is going to present performance in a way that emphasizes their mistakes. I just want to come back to one point that you made to make sure we understand. You talked about alignment. Are you speaking about the fee structure that the manager carries and how it's aligned with investor goals, or about, say, compensation of individual team members? Talk about alignment.
Yeah, so Bob, I was actually talking about the team, but you're totally right. Fee structure matters as well. And then this has got some publicity in the beginning of last year, even to the point of how are fees being taken? Because the example last year, I'm not going to name the asset manager, but an asset manager was taking performance fees on performance that was not locked in quite yet. And that could be quite problematic. So you really do want to be aligned with the manager. Their fees should be appropriate. And ultimately what you care about is expected net return. You care obviously about fees, but you care about what is the expected net return versus the risk and what you're trying to capture. Because I do think, by the way, performance-related fees, higher fees on certain products, totally reasonable. Some of this stuff's harder than other things, and so there's levels of expertise needed. So I don't necessarily have issues on any level of fees, but you have to understand what is the standards and how it'll affect your stream of returns.
Thank you. Let's move on to the third requirement, which is how the manager operates, what is their operational process. This tends to focus more on the workflow for the RIA, as opposed to the workflow embedded in the manager. But it's the reason that many advisors elect to stick solely with interval funds. How do alternatives change the ongoing workload for advisors from reporting to client communications?
Yeah, the reporting is so onerous. I mean, Bob, we spoke about interval funds on our last episode. They're really popular because they minimize the operational hurdle. They minimize the need to go back to clients and say there's a capital call, very nice tax documentation. So all those make an interval fund compelling, and they make other products really hard to deal with. And there's no standardization in terms of docs. And the industry had not really been set up operationally to deal with these docs or to set up with all the operational difficulties of a capital call structure. And because of that, and I believe we're going to have a conversation maybe next episode about it, because of this, there's been this huge fintech, I'll call it growth. You have the iCapitals and cases, which have been early on, which on one level function as access vehicles, but on another more and more provide a lot of operational support. So we're seeing it, the industry struggling with it. We've spent a lot on it to make sure that we're, us at Obsidian, to make sure that everything's seamless and you could scale your business while doing really any alt. But it's something that the industry is struggling with, and the PE shops have seen opportunity with, and you're seeing a lot of fintech. And so I think more and more solutions will come into the industry on this. And again, it's a great topic, and I look forward to discussing it with you further.
Good. We'll definitely touch on that in a future episode. What's the appropriate size for a client to allocate to alternatives? If you're an advisor who is not managing a client's entire net worth, how do you determine that sizing in that context?
Yeah, great question. The first thing I'll state there is that most people think in terms of dollars and numbers, and they need to change the way they think about it to percentages. Most people come in and you hear a strategy and you're like, I'll put 100K in there, or I'll put 250K in there. And it's like, what does that actually mean? What is the 100K? Is 100K 10% of your net worth, 1% of your net worth, 2.357% of your net worth. You want to think in percentages. And once you get to percentages, the math becomes a little easier, because then it comes down to what is the exposure we're looking at? Is it a broad exposure or a narrow exposure? So first you kind of want to frame the exposure of what is the max min. And by the way, a min, and it's typically dollar size, or it's always dollar size min, but the manager sometimes will set a min. So the minimum might be 100K, 250K, those round numbers I just mentioned, stay away from. But then what you want to do is you want to think about that exposure in terms of your book and saying, okay, this is a really broad-based exposure. I believe that a maximum, one could have a maximum of 5% in their portfolio. And you could play with mins where you say it doesn't make sense to put less than 1% or something. And then you could go with your math of, okay, well, if the max is 5%, and the minimum dollar amount is 100,000, then you're kind of like, okay, well, I need any client that has 2 million or more, right? That's how you get there. And then with narrow exposures, you might say the max is 2 or 3%. You might do that with something that's very aggressive. So that's the way to frame it. You frame it from what is that exposure, broad versus narrow? Where does it fit from a risk appetite? What limitations may the asset manager put on you? And then the second question, Bob, remind me of the second question. You had a follow-up there.
Yeah, if you are looking at an advisor doesn't manage a client's full net worth, how do you determine sizing in that context?
Okay, thank you. It's funny. It hit my head. I'm like, it's a really important question, and
Yeah.
we've had some conversations with advisors recently on this. To me, the best practice way to go is to create what I call a completion portfolio. It's best for the client. It's more complicated, to be frank. If a advisor or if a client has split, let's just say they gave 50% to one advisor and 50% to you, you really want to look holistically at what the client's exposure is, and you want to fill in the blanks. Just being, really simplistic. If you have a client that everybody agrees should have a 50-50 exposure, 50% equity and 50% conservative credit, and for whatever reason, the other advisor has 100% in equity, you serve the client best by putting them in 100% credit. Now, if equity markets have done what they've done the last 2-3 years, that other advisor is going to kick your butt. They're going to perform way better. And that becomes more complicated to explain to the client. And so in some ways, it's easier just to do in a microcosm, like what you claim you want to do for them and say, okay, here's equity, fixed income, alts, etc. You just have to do a really strong, effective job in communicating why you're doing what you're doing and how you're completing it. So that's my answer, Bob. And so when you think about going to an advisor or a client and saying, hey, I have this wonderful infrastructure alternative opportunity I want to speak to you about, you have to really put it in context of what's going on in their complete portfolio, and hopefully the client appreciates that.
Great. So our fifth and final requirement is client communication. What communication should advisors offer to their clients, and what do you look for in an alternative manager that enables the advisor to be able to do that?
Yeah, so most alternative managers have some client-approved presentations which you can use. I would always step back with the client and explain our ultimate goals and objectives by using the alts. So you kind of step back and say, listen, we believe this will be a diversifier, or we believe this will be opportunistic for you, or both. Really define what the exposure is. And then it's really important to discuss the risks, especially the illiquidity risk. You are supposed to receive a premium for that risk. You could explain that, But ultimately, you need to explain that, especially, by the way, when it comes to interval funds, because at some point the client will become aware, not immediately, that they could get out on a quarterly basis and that the asset manager provides a 5% level of liquidity. But you really need to prepare the client that when they want to get out, whether just naturally because they're ready to get out or because there's underperformance or for any other reason, it might take a year. It might take more than a year to exit. And those are, if you don't get there early, those could really ruin a relationship just because the client's ready for their money and that's it. There's no real secondary markets here. If you have a client who really, really needs to get out, and Bobby gets to some of the earlier questions we were talking about of when is appropriate even to put someone in, they're going to potentially take a discount of 20 to 40% off what is claimed as NAV to get out from through some secondary party. Maybe even more, by the way. 20 is probably too aggressive. It's probably 40 to 50%. And that's just not, it's not going to be beneficial for anyone. So you want them really to understand early on the liquidity risk and then the fact that there's risk. There's risk in everything. But so it goes back to like, why are we doing it? And then you could frame it. The asset manager typically will help you frame what they're doing with client approved. And I would recommend sticking with their client approved presentations rather than trying to make one's own.
So we've talked about what the best practices are with alternatives for an advisor, but I'm curious, what are the biggest mistakes that you've seen advisors make when it comes to using or introducing alternatives for their clients?
Yeah, they just get really attracted to a narrative. They get attracted to that mountain chart and they kind of point to past performance and that could really catch you. So you want to, these are exciting. It's one of the things we spoke about where the narratives are really compelling. You get to tell a new story. We kind of talked about how on the golf course, nobody's talking about models. They're talking about alts because they're compelling. In the same way, stories are what attract humans generally. It's really easy to get attracted to that story. And that's why it's so important to actually have a written due diligence framework to make sure you're looking at every element of it to really be scientific about it as opposed to emotional about it. And so now going back to that client, you want to take some of those same tools where, again, you step back for a moment and say, well, why are we doing this, right? Because one way to say it is, well, we're doing this because this asset manager's returned 25% a year and we want to gain 25% a year and look at this beautiful chart and that's what we want, and et cetera, et cetera. And obviously, so you want to step back and just talk about the ultimate goal, how we're sizing, speaking just, more to those elements. You still get to tell the exciting, compelling story. Obviously, but you just want to make sure you frame it and you want to make sure you talk about the risks. It's just an important element of the narrative. So I think some get just a bit too excited about one and just stick to the narrative and you got to go, meaning the high level story, and you have to go beyond that. You have to make sure you touch risks and the like when speaking to clients so that they really understand some of the downsides of potential downsides of what they're getting into. It's always risk with reward.
So we're going to put a link to a white paper in the notes that accompany this episode. Tell us about that white paper. What can advisors expect to learn from it?
Yeah, definitely. Thank you for pointing it out. As we discussed, the investment landscape is becoming increasingly complex. Once upon a time, it was all about model portfolios, and those were operationally quite efficient, quite easy to use. There was a lot of tech built up in the industry for that, and that's no longer the case. Nowadays, you have really complex tax optimization vehicles, and then you have these non-liquid alternatives. Before you even get to the operational hurdles, they're really complex from an investment standpoint, where it does take a decent amount of expertise and a decent amount of time to really dig in. And so with this new reality, the white paper really discusses how to scale in this new age to $1 billion and beyond. And we have a case study on doing exactly that, on taking, we've here at Obsidian have helped a $100 million advisor get to north of $1 billion. And, how do you do it with just quality institutional level investing and the operational efficiencies needed, the tech infrastructure needed to scale and keep on growing.
So we've covered the 5 requirements for establishing an appropriate allocation to alternatives, which are exposure, due diligence, operational workflow, sizing, and client communication. But if there's one key takeaway that you'd like to leave with advisors and our listeners about building a successful allocation to alternatives, what would that be?
Yeah, so first off, I would point out, as we pointed out in the beginning of this conversation, largest asset managers in the world are looking to democratize the space. So you have to have a view, you have to have an opinion. Once you start building out alternative investments on behalf of your clients, you want to think about what your goal and your objective is. In our view, that goal and objective is to provide diversification, to provide at times opportunistic investing. And then finally, and to more answer directly your question, it's really about process and workflow internally and how you deal with it. And what I'd say is just recognizing the complexity will put you in the right head space, because by recognizing, wait, these investments, these exposures, these processes are quite complex, it'll allow you to focus on risk management and hopefully it'll allow you to focus just on one's own modesty. I guess I could go out there and claim I have just like an incredible amount of experience in complex derivative product. But guess what? When I saw CLO, I'm in the same spot as everyone else. I hadn't seen one before. And so I had to go in with the modesty of understanding, like, I don't know anything. Explain everything to me. And so I think, again, having that headspace of coming in and just understanding this is complex is a great, I'd say, start there. And once you start there, you'll start building out a framework and the seriousness necessary to really get behind and build a proper and successful alts program on behalf of your clients.
So acknowledge the complexity and be humble. Thank you for listening to Advisor Wars with Bob Hoopsher and Joe Halpern. To learn more about Obsidian CIO or Joe's work, we'll include a link to his contact information and a link to the firm's website in the notes that accompany this podcast. You can also find Advisor Wars on Apple, Spotify, and YouTube, and we'll include a link to connect with us on LinkedIn in those show notes. Stay tuned for our next episode when we speak with an expert on implementing alternatives who will explain why they have become so popular in this environment.
Obsidian CIO sponsors the podcast to further education and critical thinking about the factors that affect markets and investing. And the podcast does not provide investment advice. Investment advice is offered only to clients of Obsidian CIO who have entered into an advisory agreement and with whom Obsidian CIO has identified individual objectives, risk tolerance, and other investment needs.